This video is going to be the most important one of your trading journey. By the end, you will have the skills to confidently analyze and trade using these patterns. This video will teach you all the candlestick patterns you need to know, along with live chart examples. In this video, we will cover the basics of candlesticks, support and resistance, single candlestick patterns, double candlestick patterns, and triple candlestick patterns. Let's first look at the structure of candlesticks. This is a candlestick, and this part is the body of the candlestick. These are called wicks. This is the upper wick, which shows the highest price of that time period, and this is the lower wick, which shows the lowest price of that particular time period. Candlesticks are of two colors, green and red. A green candlestick forms when, after the opening of the candle, the price goes up and closes above the opening price. This is the upper wick, and this is the lower wick. A red candlestick forms when, after the opening of the candle, the price goes down and closes below the opening price. This is the upper wick, and this is the lower wick. The total area of the candle is called the range. In comparison to the range of a candle, if the closing price is closer to the high of the candle, that candle is considered a bullish candle. Conversely, if the closing price is closer to the low of the candle, that candle is considered a bearish candle. A bullish candle forms when buyers are more powerful than sellers during the formation of the candle. A bearish candle forms when sellers are more powerful than buyers during the formation of the candle. Now look at these candles. Based on their color, you might think the green one is bullish and the red one is bearish. However, according to the range, the closing price of both candles is near the low of the candle, so both of them are bearish candles. But there is an exception to this theory. Look at these candles. Their bodies are small and positioned in the middle of the range, with their lower and upper wicks being the same size. These are called indecision candles, meaning they are neither bearish nor bullish. In this case, you should wait for the next candle before making a trading decision. Now let's look at some basics of support and resistance. A level where, after a downtrend, the price reverses multiple times is called a support level. A support level forms because buyers are interested in buying at that specific price. So whenever the price reaches that level, buyers start buying again, and the downtrend turns into an uptrend. A level where, after an uptrend, the price reverses multiple times is called a resistance level. A resistance level forms because sellers expect the price to fall at that specific level. So whenever the price reaches that level, sellers start selling again, and the uptrend turns into a downtrend. Support and resistance levels are also called key levels. We have learned the basics. Now let's start with candlestick patterns. If you want a complete in-depth video on support and resistance levels, let me know in the comments section. The more comments I get, the sooner I will upload that video. Now let's learn the Dragonfly Doji candlestick pattern. Dragonfly Doji is a single candlestick pattern where after the candle opens, sellers initially drive the price down. However, at lower levels, buyers enter the market, pushing the price back up, and the candle closes near its opening. This shows that sellers failed to maintain control, while buyers managed to regain control, indicating potential bullish reversal. The Dragonfly Doji typically has a very small or non-existent body, with a long lower wick that suggests strong buying pressure at lower levels. Sometimes a small upper wick may be present. This pattern can appear in either red or green. Here color doesn't matter. Though a green Dragonfly Doji candle is considered a slightly stronger bullish signal. Now let's look at an example. This is a 5-minute time frame chart. Shortly after the market opened, the price faced rejection at lower levels, creating a long lower wick on the chart. This is known as a Dragonfly Doji, signaling a potential bullish reversal. It suggests that the market is trying to establish support at this level, as buyers repeatedly push the price higher, causing it to trade within a range on the chart. With sellers losing control, buying pressure builds, and the price breaks out of this range with a strong green candle moving upward. After a Dragonfly Doji, if a bullish green candle forms, it can signal a long trade entry with a stop loss placed below the support area. When a Dragonfly Doji forms near a strong support level, the chances of a market reversal increase. Let's move on to the Gravestone Doji. Gravestone Doji is a single candlestick pattern where, after the candle opens, buyers initially drive the price up. However, at higher levels, sellers enter the market, pushing the price back down, and the candle closes near its opening. This shows that buyers failed to maintain control, while sellers managed to regain control, indicating a potential bearish reversal. The Gravestone Doji typically has a very small or non-existent body, with a long upper wick that suggests strong selling pressure at higher levels. Sometimes, a small lower wick may be present. This pattern can appear in either red or green, as color doesn't play a significant role here, though a red gravestone doji candle is considered a slightly stronger bearish signal. Now let's look at an example. This is a 5-minute time frame chart. As soon as the market opens, the price faces rejection from lower levels, forming a long wick candle on the chart, which we call a dragonfly doji candle. This signals a bullish reversal, indicating that the market is trying to form support at this level. Therefore, buyers repeatedly try to push the price up, causing the price to trade within a range for some time. In this situation, the buyers are attempting to raise the price from the lower levels, but due to the low buying pressure, they fail to break their day high. This indicates that the day high is acting as a strong rejection key level. After a while, the price breaks day's swing low with a strong bearish candle and goes down rapidly. Now let's learn the hammer candlestick pattern. The hammer candlestick pattern, a crucial reversal signal in price action trading. This pattern typically forms at the end of a downtrend and signals a potential reversal to an uptrend. Here the price is in downtrend, and in the bottom area, a hammer candle is formed and the price reverses and goes up. In a hammer candlestick, the body is relatively small, and the lower wick is significantly longer, often at least twice the length of the body. This extended wick indicates that sellers initially drove the price down, but buyers stepped in to push it back up, showing a possible change in market momentum. The hammer candle can be either red or green in color. Here the color of the candle does not matter, though a green hammer may be a slightly stronger bullish signal. According to price action, the downtrend represents the seller's control, but they start to lose control and exit their positions. At the same time, new buyers come in and push the price up. Because of this, the trend changes from a downtrend to an uptrend. Here in the market, some of the existing sellers try to pull the price down, and the rest of the sellers start booking their profits, which weakens the strength of the sellers. At the same time, the new buyers make their entry in the market and take the rest of the sellers out of the market and convert the downtrend into an uptrend. Let's examine some chart examples. In the second example, on a bearish trend chart, two big red candles show up, leading to a sharp drop in the market. With such a big price drop over these two candles, there aren't any new sellers left afterward, so the price keeps dropping but with smaller red candles. Noticing the reduced selling activity, new buyers enter, leading to a hammer pattern on the chart. But once again, the sellers try to pull the price down, but due to the increasing buying pressure, the price reverses and goes up. Let's check out a third example. Here, during an uptrend, the price action keeps making higher lows as it rises, but after a while, sellers enter the market and reverse the price and bring it down, forming a support area at a lower level on the chart. When the price hits this support area, sellers cut back on selling, take profits, and close positions. At the same time, new buyers enter at this level, and the price continues its uptrend. On any chart, you shouldn't take a reversal trade just by spotting a hammer candlestick. You'll need to combine it with a support line in the price action on the chart. In the next example, while the price is moving up, higher lows continue to form as it rises. As soon as the price reaches a new high, buyers who already entered the market start taking profits, causing a small pullback. By drawing a support line at the last high, we see new buyers entering as the price reaches this level again, forming a hammer candle. Here the price continues its uptrend, supported by the previous high and a moving average from below. Here new buyers use the hammer as an entry point. By combining the candlestick pattern with key levels in price action, you can identify potential long trade entries. Now let's look at hanging man candlestick pattern. The hanging man candlestick pattern is a single candle formation that appears in a short-term uptrend when the price reaches a nearby resistance level. As soon as the candle opens near the resistance, the sellers enter the market, pushing the price down. However, buyers at lower levels bring the price back up, closing it around the opening level, resulting in a candle with a small body and a long lower wick, forming a hanging man candle. This pattern suggests that the market is struggling to sustain its bullish momentum as it encounters resistance. When sellers gradually increase pressure, the next candle often closes at a lower level, leading buyers to begin booking profits, which adds to the selling pressure. If the price breaks below the low of the hanging man candle, it can trigger a fast downward movement. For trading, one could place a stop loss above the high of the hanging man or slightly above the resistance level and consider entering a short trade if the price breaks the low of the hanging man candle. New traders often get confused between the hammer and hanging man candlestick patterns because they look very similar. However, these two patterns indicate different market signals. The difference between the hammer and hanging man candles is that the hammer appears after a downtrend and signals a bullish reversal, while the hanging man appears after an uptrend and signals a bearish reversal. Let's now discuss the shooting star pattern. The shooting star pattern is a single candlestick pattern consisting of only one candle. When the market is in a short uptrend and the price is near its resistance level, this candle forms at the top, which we call the shooting star candle. Looking at the previous trend, at a higher level near the resistance area, buyers push the candle above the resistance level, but after a while, sellers enter the market and push the price down. Additionally, some buyers starts booking profits, causing the candle to come down slowly and close below its opening, creating a long upper wick. This indicates that fresh buyers are not ready to enter the market, so the price lacks support to move above the resistance level. Since the price is already in the resistance area, sellers show interest in selling at this higher level, which increases selling pressure and closes the price lower. After the shooting star candle, if a bearish candle forms and closes near or below 50% of the previous green candle, you can set your stop loss at the high of the shooting star candle's wick and enter a short trade. Now let's understand the psychology of buyers and sellers behind this. Here, the buyers who entered the long trade at lower levels have made a good profit due to this bullish move. Therefore, as soon as the price approaches the resistance area, some of them book their profit. Meanwhile, some new buyers enter a long trade, thinking there will be a breakout of the resistance level. However, since the price has already risen significantly, when it approaches the resistance level, a reversal occurs, and sellers start selling at these higher levels to avoid missing the opportunity. Because the number of sellers now exceeds buyers, the candle goes down and closes below its opening. When buyers enter the long trade, their stop losses are typically set below this green candle. As soon as the market drops from this level, buyers' stop losses are triggered, causing the price to drop rapidly. The shooting star candle is a bearish reversal signal. Now let's see some examples from the chart. In this example, as soon as the market opens in the morning, the price goes up, creating strong bullish candles and trading in a range for a while. After a while, a strong bullish candle breaks out of this range, continuing its previous trend. However, at the top level, the price faces resistance, comes down, and closes below its opening, forming a shooting star candle on the chart. At higher levels, due to profit booking by buyers and the entry of sellers, bearish candles form on the chart. However, the previous green candle's low is not broken, due to which the fresh buyers try to take the price up again, but fail. Seeing this, sellers increase selling pressure, and the price drops, closing below the swing low, which panics buyers. They exit their positions, causing a rapid price drop. Now let's discuss the inverted hammer candle. The shooting star candle forms at a high level after an uptrend and signals a bearish reversal. Conversely, the inverted hammer candle forms at lower levels and signals a bullish reversal. If you invert the hammer candle, you get the inverted hammer candle. In the market, when the price is close to its support level in a short-term downtrend, sellers starts booking profits, causing the price to rise temporarily before falling back down and closing. Recognizing the weakness in selling, buyers enter the market and push the next candle higher, causing sellers to fear losing their profits and close their positions. Additionally, fresh buyers enter when the price nears the support level, helping push the price up and reverse the trend. This way, buyers capitalize on sellers' fear. Now let's look at some examples. This is a 5-minute time frame chart. Here, the market closes at lower levels at the end of the day by forming a shooting star candle in the second half of the day, facing rejection at higher levels after a small uptrend. The next day, the market opens with a gap down. The price tries to rise with support from the previous day's low, but fails, resulting in an inverted hammer candle on the chart. Here, buyers attempt to drive the price up twice, but sellers push it down again, but are unable to break the lower level. Seeing that sellers are weakening, and with the expectation that market will get support from the support area, buyers enter a long trade, forming a large bullish candle on the chart. Sellers who thought price will break the support area gets their stop losses threatened by this green bullish candle. Additionally, sellers who sold near this level the previous day have their stop losses close to this resistance area. In this case, there are more stop losses on the upside than the downside, so the liquidity required to push the market up is present in this area. As soon as these stop losses are hit, the price rises rapidly and continues its previous uptrend. When using candlestick patterns in price action, always remember that any candlestick pattern needs support from key levels to function effectively. Now let's discuss the Marubozu candle. The Marubozu candlestick pattern consists of a single candle. This candle's body is significantly larger than that of typical candles, with either a very small wick or none at all. There are two types, bullish and bearish. If a candle forms with a small wick and a body that is larger than many of its preceding candles. It is called a marubotsu or momentum candle, representing strong market momentum. Momentum candles typically appear during sharp price movements, as the price shifts quickly from one level to another. Let's look at an example. This is a 5-minute time frame chart. When the market opens, a large bearish momentum candle forms as the price drops. However, at lower levels, buyers enter the market, creating a bullish momentum candle. This bullish Marubozu candle has no wick, and its body is large. The bearish Marubotsu candle created selling pressure, but the bullish Marubozu candle overcame it as buyers gained control, causing a rapid price increase. As the price rises, multiple bullish Marubozu candles may appear on the chart, indicating strong buyer momentum. If you enter a trade immediately after a Marubozu candle, especially a large momentum candle with a big body, your stop loss may need to be larger than usual. Placing a stop loss too close to the entry point can expose you to minor market fluctuations, which might trigger the stop loss prematurely. To minimize your stop loss, consider entering after the close of the next candle following the Marubotsu. New traders often enter a trade before the candle closes, but many times the price will face rejection at a higher level and close below its opening price. It's wiser to wait for the candle to close. Large institutional traders often create such candles to trigger retail traders' stop losses. Here's an example. After the market opens, 2 hammer candles form, signaling bullish momentum. Sellers attempt to push the price down twice, but fail both times. When a bullish candle forms, many retail traders enter long positions. However, the next candle becomes a large bearish momentum candle, hitting the stop losses of these buyers. Then, a bullish momentum candle forms, prompting traders to re-enter on the breakout of the day's high. Yet again, a bearish candle hits their stop losses. Institutional traders often use Marubozu candles to target retail traders' stop losses. Let's learn about the tweezer top. There are 2 candles in the tweezer top candlestick pattern. One is a green bullish candle, and the other is a bearish red candle. When the green candle closes, a bearish candle opens at the same level and closes near the opening of the green candle, creating a tweezer top pattern on the chart. A short-term uptrend occurs in the market and stops near the resistance level with a bullish candle. The next candle opens at the same level, but the price does not continue its previous trend, and the candle closes near the opening of the previous green candle. From here, the green candle has raised the price, and the next red candle has brought it back down to the same level. This means that the market has failed to break this resistance area. Seeing the price reverse near the resistance area, buyers start exiting their positions, and fresh sellers also begin selling from this level, which increases the selling pressure, and the price goes down rapidly. By placing your stop loss slightly above the opening of the red candle, you can enter a short trade here. Now, let's look at some examples. This is a 5-minute time frame chart, where after the market opening, it tries to break out upwards but fails. Buyers enter the market from lower levels and try to bring the price back up, but fail to break their day's high, which creates a trend line on the chart at lower levels. This means that whenever the price touches this trend line, buyers start buying in the market and push the price up. This trend line is the last support for the buyers. If it breaks, buyers may worry about their positions. Simultaneously, seeing the downside breakout in the market due to the break in this trend line, new fresh sellers are also waiting to make their short positions here. This is where the big players in the market, which we all call operators, start their game and take advantage of retail traders' fear to get them out of the market. Let's find out how. As soon as the price breaks the trend line, some retail buyers get scared and exit their positions, and the rest of the buyers' stop losses get hit, and buyers exit the market. The stop losses of all the sellers who make short positions in the market on the breakdown of the trend line are near the trend line. Once again, the price makes 2 green candles and comes to retest the trend line, scaring the retail traders who are selling from here, making them leave the market, and the big players get the liquidity needed to place their orders. On the chart, near the trend line, a tweezer top pattern is formed, indicating the increasing control of the sellers in the market. With a strong bearish candle, the stop losses of the buyers at different levels in the market are hit, and the price goes down rapidly. As soon as the market goes a little against the traders, they get scared. Big traders take advantage of this fear and get buyers and sellers out of the market. Now, let's learn about the tweezer bottom. There are 2 candles in the tweezer bottom candlestick pattern. One is a red bearish candle, and the other is a green bullish candle. When the red candle closes, a green candle opens at the same level and closes near the opening of the red candle, creating a tweezer bottom pattern on the chart. A short-term downtrend occurs in the market and stops near the support level with a bearish candle. The next candle opens at the same level, but the price does not continue its previous trend, and the candle closes near the opening of the previous red candle. From here, the red candle has lowered the price, and the next green candle has brought it back up to the same level. This means that the market has failed to break this support area. Seeing the price reverse near the support area, sellers start exiting their positions, and fresh buyers also begin buying from this level, which increases the buying pressure and the price goes up rapidly. By placing your stop loss slightly below the opening of the green candle, you can enter a long trade here. Now, let's see some examples. This is a 5-minute time frame chart. As soon as the market opens, the price makes bearish candles and tries to go up with the support of its previous day's low from the lower level, creating a tweezer bottom pattern on the chart. Here, sellers try to take the price down, but buyers enter the market from the support area, creating a strong bullish candle. This means that sellers are failing to take the price down, and buyers are making their positions in the market. The tweezer bottom pattern is a bullish reversal signal. As soon as the price breaks the previous swing high with a strong bullish candle, the market reverses and goes up. If the tweezer top pattern is in the resistance area and the tweezer bottom is near the support area, it can give you good results. Let's understand the bullish engulfing pattern. The bullish engulfing pattern consists of two candles, a bearish red candle followed by a bullish green candle. This pattern signals a potential bullish reversal in the market. It often appears near a support area, where sellers close a strong, bearish red candle. The next candle opens below the red candle, but buyers enter the market at lower levels and push the price up, closing it above the red candle's body. The green bullish candle completely engulfs the previous red candle, covering it entirely. This is why it is called an engulfing candle. In a textbook bullish engulfing pattern, the green candle opens below the red candle's low and closes above its high, making it a perfect example of the pattern. However, in live charts, you won't always see such a perfect pattern. Sometimes the closing price of the red candle and the opening price of the green candle may look like these. Despite these variations, such patterns are still considered bullish engulfing patterns. On the chart, the price creates a lower high pattern during a bearish trend, forming a support area at the bottom and a triangle pattern. When the price first approaches the support, it attempts to reverse but fails. On the second attempt, buyers begin buying actively, and the price breaks out of the triangle pattern while forming a bullish engulfing candle. This signals the start of a bullish trend. Let's understand the bearish engulfing pattern. The bearish engulfing candlestick pattern consists of two candles, a bullish green candle followed by a bearish red candle. This pattern signals a potential bearish reversal in the market. It often appears near a resistance area where buyers close a strong bullish green candle. The next candle opens above the green candle, but sellers enter the market at higher levels and push the price down, closing it below the green candle's body. The red bearish candle completely engulfs the previous green candle, covering it entirely. This is why it is called an engulfing candle. In a textbook bearish engulfing pattern, the red candle opens above the green candle's high and closes below its low, making it a perfect example of the pattern. However, in live charts, you won't always see such a perfect pattern. Sometimes, the closing price of the green candle and the opening price of the red candle may be the same. Despite these variations, such patterns are still considered bearish engulfing patterns. After a short-term uptrend, when the price approaches its nearest resistance area, buyers may attempt to break through the resistance but fail. The next candle opens above the green candle's high, but sellers enter at higher levels, driving the price lower. This creates a large red candle that completely engulfs the green candle, forming the bearish engulfing pattern. This pattern is a strong signal of a bearish reversal. By placing your stop loss a little above the resistance area, you can enter a short trade after the closing of this red bearish candle. Let's look at some examples. When the market opens, the price drops, forming an indecision candle. At lower levels, buyers try to push the price higher to break the day's high, but fail, creating a small resistance area on the chart. The next candle opens near this resistance area, and sellers push the price down, forming a strong red candle that completely engulfed the previous green candle. And this creates a bearish engulfing pattern at the resistance level. Here, it's important to understand the psychology of buyers and sellers. When the market opens, based on the previous day's trend, sellers push the price down again. However, near this level, a support area is visible on the chart. As the price nears the support area, sellers start booking profits, causing a slight pullback and pushing the price higher. However, the price fails to break the day's high, indicating that fresh buyers have not entered the market at lower levels. If fresh buyers had entered, the price would likely have attempted to break the resistance. Seeing this, new sellers enter the market at higher levels, increasing selling pressure and causing the price to drop further. Let's start with the piercing line pattern. In the piercing line candlestick pattern, there are two candles. One is a bearish red candle, and the other is a bullish candle. It works as a bullish reversal signal in the market. In the market, near the support area, sellers close a strong bearish red candle. The opening of the next candle is below this red candle, but at lower levels, buyers enter the market and push the price higher, closing it at a higher level. The piercing line pattern is considered valid if the body size of the bullish green candle covers more than 50% of the previous red candle. Sellers initially open the price at lower levels, but buyers start buying actively because the price is near the support area, creating a strong bullish candle on the chart. If the closing of the next candle is above this red candle, then this candle will serve as a pattern confirmation, creating a bullish reversal signal on the chart. By placing a stop loss below the support area after the closing of this third green candle, you can make a long trade entry. Now let's learn about the dark cloud cover pattern. There are two candles in the dark cloud cover pattern, one of which is a strong red candle, and the other is a green bullish candle, and it works as a bearish reversal signal in the market. When the price comes near the resistance area in the market, it creates a strong green candle on the chart. The opening of the next candle is above this candle, but at higher levels, sellers enter the market, closing this candle below the resistance area. The buying pressure created by the buyers in the market is completely eliminated, and at higher levels, sellers start to take control of the market. Here, if the closing of this red bearish candle is below 50% of the body size of the previous green candle, then this dark cloud cover candlestick pattern is considered valid. If the closing of the next candle is below this green candle, then you can see it as a confirmation candle because here sellers are dominating the buyers. Just above the resistance level, you can place your stop loss and enter a short trade after the closing of this red candle. Now, let's talk about the 3 inside-up candlestick pattern. There are 3 candles in the 3 inside-up candlestick pattern, one of which is a strong bearish candle, and 2 bullish candles. There is a short-term downtrend in the market, and when the price comes near the nearest support area on the chart, it creates a strong bearish candle. Here, sellers push the price down but cannot break the support area. The opening of the next candle is at the closing of the same red candle, and the price goes up, creating a small green candle. The closing of this candle is within the previous red candle, so we call it an inside candle, which you must have heard about many times. The third candle opens at this level and closes above the red candle, creating a 3 inside-up candlestick pattern on the chart, which is considered a bullish reversal signal in the market. Here, the selling pressure created by the sellers near the support level has been completely eliminated by the buyers with these 2 green candles. If such a 3 inside-up pattern is made near a strong support level in the market, then you can enter a long trade by placing your stop loss slightly below this green candle or support level. Let's now understand the 3 inside down pattern. There are also 3 candles in the 3 inside down pattern, one of which is a strong bullish green candle, the other is a small inside red candle, and the third candle is again bearish. When the price in the market comes to the resistance area, new buyers create a strong green bullish candle to break the resistance area, but the price cannot break the resistance area, and the candle closes in this area. Some buyers make a profit by booking here due to their profit target being hit, which creates an inside red candle on the chart. The opening of the next candle is below the closing of the same candle, and the price goes down, closing below the previous green candle, creating a 3 inside-down candlestick pattern on the chart, which is considered a bearish reversal signal. In the resistance area, selling pressure increases due to buyers booking profits and sellers entering at higher levels. You can enter a short trade by placing your stop loss slightly above this resistance area. Let's now understand the 3 outside up pattern. There are 3 candles in the 3 outside up pattern, one of which is a bearish candle, the other is a strong bullish candle, and the third is a normal bullish candle. After a short-term downtrend in the market, when it comes to its support area, its momentum is reduced and small red candles form on the chart. Seeing that the sellers are weak, buyers begin buying actively from the support area, which creates a strong bullish candle on the chart and closes above the previous red candle. A bullish candle is formed again at higher levels on the chart, which creates a 3 outside up pattern, which works as a bullish reversal. This means that the price has failed to break the support area, and buyers are dominating the market. If the size of the third candle is similar to a normal green candle, you can place a stop loss below the support level. However, if the third candle is a strong, large bullish candle, you can place a stop loss slightly below the low of this candle and plan a long trade entry. Let's now understand the 3 outside down pattern. The 3 outside down pattern is also created by combining 3 candles. When a strong upside move occurs in the market, the price reaches its nearest resistance area and closes with small green bullish candles. Here, near the resistance area, the size of the candles is smaller than before. This means that by reducing the buying pressure here, the market momentum has slowed. After seeing this, many buyers start to book profits, which causes the price to face rejection from a higher level and creates a strong red candle on the chart. After the buyer's profit booking, new fresh sellers join the market, creating another red candle on the chart, and the price goes down. As a result, near the resistance area on the chart, a 3 outside down pattern is formed. The third red candle here works as a pattern confirmation, which signals a bearish reversal. By placing a stop loss at the resistance area, you can enter a short trade after the closing of the third candle. Let's understand Morningstar candlestick pattern. The Morningstar candlestick pattern is made by combining 3 candles. One of them is a strong bearish candle, the second is a small indecision candle, and the third is a bullish candle. The market is in a short downtrend, and while reaching the price support area, sellers try to take the price below this support area, which creates a strong bearish red candle on the chart. The opening of the next candle is below the previous candle, and the sellers once again push the price down. But due to weak selling pressure, the price does not go down much. As the price is close to the support area, buyers start making their entry here, which closes the price by going up a little, and a small indecision candle is formed on the chart. The color of this candle can be red or green. After seeing this candle, buyers start heavy buying again, and while pushing the price up, they close the candle around the 50% level of the previous red candle. This means that sellers are slowly losing control in the market and buyers have become dominant. If the closing of this green bullish candle is near the 50% area of the previous red candle or a little above, then it is a standard bullish signal. But if the closing of the third candle is above the opening of the previous red candle, then it is considered a strong bullish signal, because here buyers have completely succeeded in making themselves dominant over the sellers, which increases the possibility of the price changing its previous downtrend into an uptrend. After seeing this pattern, before entering the trade, you will have to understand the psychology of the buyers and sellers behind it. Here sellers sell from the top level, which touches the support area, while the price comes down. This means that most of the sellers here have already profited in their positions. But there are some sellers who feel that the market is going to break this support area and go down. Therefore, new sellers who did not get a chance to sell above make an entry at this level. But the price has already come down so much that the sellers who are selling above, due to their profit target being hit, book profit, which does not allow the price to go down. Seeing the sellers being weak and the price being close to the support level, a reversal can occur in the market from here. Thinking this, buyers make their entry, which closes the candle by going up. This means that as soon as the price comes above the previous red candle, sellers start exiting their positions to save their profit. And seeing this bullish signal, buyers buy again, which reverses the market from here and goes up. Let's now look at some examples on the chart. This is a 5-minute time frame chart. Here, the price is trading in a strong uptrend with a formation of higher lows from the morning. If you draw a trend line from below on the chart, then the price is repeatedly taking support of this trend line. And here at this point, a resistance level has been created. But the price goes up by breaking this resistance level with a strong bullish candle. However, by booking profit by buyers at higher levels and adding some new sellers to the market, the price comes back to the same trend line by making a correction. Here, buyers start buying again in the market, which causes a morning star candlestick pattern on the chart. Here, the price is coming from below the trend line and the previous resistance level, which is now working like a support. It is taking support from both of them, which gives buyers interest in buying from this level. That's why you can put your stop loss below the trend line and enter a long trade. Due to the increasing buying pressure, the price goes up from this level and breaks the previous swing high. As soon as this level breaks, all the sellers' stop losses are hit and the price goes up rapidly. Let's now learn evening star candlestick pattern. A evening star pattern is made up of 3 candlesticks, a strong bullish candle, an indecision candle, and a bearish candle. When there is a short-term uptrend in the market and the price is near resistance level, buyers try to break this resistance level by pushing the price upwards, closing a strong green bullish candle near the resistance area. The opening of the next candle occurs above the closing of this candle and the price continues its trend. However, buyers who bought at lower levels have already made some profit due to this bullish move and do not want to lose it. Therefore, as the price approaches the resistance level, these buyers start exiting their positions, gradually preventing the price from going much higher than the resistance area. At the same time, sellers see the resistance in the market and create their selling positions at higher levels, forming an indecision candle on the chart. Whenever sellers and buyers are confused about their entry at a certain point in the market and are afraid to make a strong decision, or their strength is equal, an indecision candle forms on the chart. When you see such a candle on the chart, you should understand that new buyers do not make fresh entries near this level, and some buyers book their profits, which we call long unwinding, causing the price to gradually move downwards. This activates sellers to sell actively, forming a bearish candle on the chart. If the closing of this red candle is slightly below the 50% area of the previous green candle, or below the opening of the green candle, it indicates increasing strength of sellers in the market. The larger the red candle, the stronger the sellers in the market. Remember this pro tip whenever you look at a candlestick pattern. Instead of just seeing the candle as red or green, you should understand the mindset or psychology of the trader behind the formation of the candle. The color of any candle reflects the mood, emotions, and current interest of buyers and sellers in the market. Therefore, always keep this in mind while looking at the chart. Now let's understand the psychology behind this pattern. Buyers who bought at lower levels have made a good profit due to this upside move in the price. Therefore, as the price reaches this resistance level, some buyers book their profits while others hold their positions, hoping the market will go higher. However, as the price faces rejection at higher levels and tries to move down, the buyers who are already in profit get scared and start exiting their positions, increasing the selling pressure near the resistance level. Seeing the buyers exit, sellers start entering short positions, causing the price to move further down and increasing the likelihood of the previous uptrend converting into a downtrend. Here, sellers take advantage of the buyers' emotions and dominate the market, pushing the price down. In this way, buyers and sellers take advantage of each other's emotions in the market. Now, let's look at some examples on the chart. This is a 5-minute time frame chart. After the market opening, the market continues a strong uptrend, forming higher lows. Buyers at lower levels have made a good profit due to this upside move in the market, and some of them book their profits towards the end of the day, causing long unwinding at this level on the chart. However, some buyers hold their positions for the next day. The next day, when the market opens with a gap up, these buyers start booking their profits, causing a correction in the market. But as the market approaches its previous day's high, buyers start hoping the uptrend will continue and start buying again and push the price upwards. Here, buyers try to push the price up twice but fail both times. However, the third time, when the price reaches this level, sellers start selling again, forming a small resistance level on the chart and creating an indecision candle along with the evening start pattern. This indicates that sellers are not interested in pushing the price higher, increasing the selling pressure, and causing the price to fall. One reason for the market's decline here is stop-loss hunting. Let's understand this a bit more. Throughout the day, the market trades in an uptrend, leading many buyers to believe that this trend will continue the next day. They create positions at different levels, placing their stop-losses somewhere around here. Additionally, buyers entering the market at this level place their stop-losses near the previous day's high, considering this level as a support for them. As long as the market is above this level, they are not afraid to hold their positions. In the morning, after the market opens, only profit booking occurs, so very few sellers are added here. As a result, fewer stop-losses are placed upwards compared to downwards. According to the smart money concept, big institutional traders need liquidity to execute their large orders in the market, and retail traders' stop-losses provide that liquidity for them. If you look closely, most stop-losses are placed at lower levels, meaning the highest liquidity is there. To grab this liquidity, big traders increase the selling pressure, hitting the retailer's stop-losses and causing the market to drop rapidly. I hope you now have a clear understanding of how to use these candlesticks for your trading. Thanks for watching. If you found this tutorial helpful, please give it a thumbs up and subscribe to our channel for more trading tips and strategies.